Are you renting a home or apartment in 2026? Then this could save you thousands of dollars. Many renters believe their landlord's insurance protects their belongings, but that's simply not true. Renter's insurance can help cover stolen items, fire damage, temporary living expenses, and even liability claims if someone gets injured in your home. The good news? Top-rated companies like ACA and State Farm offer affordable coverage with valuable discounts. Before choosing a policy, compare coverage limits, document your belongings, and understand exactly what's included. A small monthly payment today could protect you from a major financial loss tomorrow. Let's discover the best renters insurance companies of 2026.
For just about $15 a month, renter's insurance is the cheapest financial safety net that you can buy. But because it's so cheap, most people treat it like a technicality. They buy the absolute bare minimum default policy online just to get a proof of insurance document that satisfies their landlord's lease requirement. A typical renter estimates their belongings at $5,000. But calculating the cost to replace your furniture, clothing, and electronics brand new, it's $20,000 to $70,000. Since landlord policies only cover the building, that massive gap becomes your direct out-of-pocket loss. We are going to decode the 4 major traps hidden in standard renters policies and map out the exact insurance architecture you need based on how you actually live. Optimizing strictly for the lowest monthly premium without matching the coverage to your specific lifestyle is the most expensive mistake you can make. The first trap is selecting an actual cash value policy. Insurers heavily promote this option because it shaves a few dollars off your monthly premium. Actual cash value relies on depreciation. When you file a claim, the insurance company doesn't write you a check for what an item costs at the store today. They pay you what the item was worth in its used, aged condition on the day it was destroyed. Looking at this timeline, you can see how aggressive the math gets. If you bought a laptop for $1,000 and it gets stolen when it's 3 years old, its used market value might only be $300. After paying your deductible, your payout barely covers a replacement charger. The alternative is replacement cost coverage. Under this model, depreciation is ignored. The insurer pays the exact retail price required to put a brand new, equivalent laptop back on your desk. Upgrading to a replacement cost policy typically costs less than an extra coffee a month, but it prevents you from having to spend hundreds out of pocket to replace everyday essentials when you need them most. The second trap happens when unrelated roommates decide to split a single renter's policy to cut their monthly bill in half. When you share a policy, you share everything. You are legally bound to a single total coverage limit. You split one deductible, and most importantly, you share a single claims history. This creates a severe liability hazard. If your roommate accidentally leaves a stove on and causes a massive kitchen fire, that insurance claim attaches directly to your personal record, regardless of who is at fault. Insurance companies use your claims history to calculate your personal risk profile. A major claim on a shared policy will raise your future insurance rates for years, following you even after you move out and live completely alone. Permanently isolating your claims history by purchasing your own individual policy provides far more long-term value than saving $3 or $4 a month on a split bill. The third trap is the assumption that your standard policy provides full protection for high-value gear, like laptops, cameras, and bicycles, while you are traveling. Here is a standard renter's policy declarations page. We can see the total personal property limit is set at $10,000. That covers the belongings inside the apartment. But buried in the fine print is an industry-standard clause called the out-of-home supplement. This clause automatically caps your coverage for items stolen outside of your apartment at just 10% of your total property limit. This pie chart illustrates the reality of that supplement. If your camera bag and laptop are stolen from a hotel room, a $10,000 policy will only pay out a maximum of $1,000, leaving you completely exposed. To fix this, you have to purchase a scheduled personal property rider. This add-on allows you to specifically list high-value items, providing them with full value coverage against theft or accidental damage anywhere in the world, usually with no deductible. Frequent travelers must explicitly schedule their gear. A default policy treats off-site theft as a secondary, highly restricted risk. The final trap is prioritizing an app's convenience over the strength of a company's claim support when you are choosing your provider. Digital-first insurers offer undeniable perks. You can get an instant quote on your phone, there is zero paperwork, and their AI chatbots can often process simple claims, like a stolen bicycle, in a matter of minutes. The trade-off with the digital model is the lack of a dedicated human advocate when you are facing a high-stakes total loss, like an apartment fire that completely displaces you from your home. In a disaster, your most critical asset is loss of use coverage, also called additional living expenses. This pays for your temporary housing, hotel bills, and increased food costs while your apartment is unlivable. Looking closely at this policy document, you can see Coverage D, loss of use, sits entirely separate from your personal property limits. It is a distinct pool of money designed specifically to keep a roof over your head. Navigating housing extensions and negotiating long-term loss of use limits requires nuance and persistent follow-up. That process is vastly easier when you have a direct line to a traditional, local human agent, rather than relying on an automated chat interface. While AI insurers easily win on speed for simple, low-value claims, traditional insurers provide superior infrastructure for navigating high-stakes disasters. Knowing these 4 traps lets us map the correct policy architecture to 3 distinct renter lifestyles. First is the first-timer, or roommate. You are budget-conscious, living in a shared space, and your primary goal is baseline protection for your bedroom. This flowchart maps the optimal route. For this profile, choose separate, individual, digital-first policies. They cost roughly $10 to $15 a month and strictly isolate your claims history from the people you live with. Next is the high-tech traveler. You are frequently on the move and carry valuable cameras, laptops, or sporting equipment. You need a policy that combines replacement cost coverage with a scheduled property rider. This structure completely bypasses both the off-site sublimits and aggressive depreciation math. Finally, the established renter. You've accumulated higher quality furniture and significant assets over several years. You should route toward traditional agent-backed insurers. Your asset risk is high enough to require guaranteed maximum loss of use support and reliable human advocacy for a major claim. The best renter's insurance company does not exist in a vacuum. There is only the right policy architecture for your specific asset risk. Even the most perfectly optimized policy is completely useless if you cannot prove what you actually owned after a disaster strikes. Take your phone today, spend 20 minutes walking through your apartment, and record a video of every room, closet, and open drawer. Uploading that visual inventory to a cloud drive provides indisputable proof of your living standard. It is the ultimate free safeguard against an insurance adjuster trying to lowball your payout. Knowing exactly what your belongings are worth, and having the video to prove it, is the only way to guarantee your monthly premium actually performs when you need it.